So good morning. It's great to see some new faces and familiar faces. So for those of you who don't know, my name is Megan Templeton. I am one of the consulting attorneys here at Royal Legal. This is our weekly tax show. And so the purpose for this show is to do a deep dive into specific tax matters, make sure we fulfill the education piece on a high level, and then also give you an opportunity to bring questions to us. So during these calls, we do record them. So want to make sure you're aware of that. If you want to change your name on your Zoom photo so people can identify you, you're welcome to do so. You'll do so by hitting the 3 buttons up in the right-hand corner of your photo. And then so from there, we do record these. Like I said, we store them on our Wistia channel. So they're available for you to go back and rewatch or share with friends and family if it's something that would be applicable to them. And then we also have got a couple other resources for you. We've got some other shows during the week. And then we also have our Discord channel, which is where we connect outside of these calls. Gives you a good opportunity to network with attorneys. You can ask questions. We've got some of our staff in there, some other investors, things like that. So for today, we're going to have a little bit of a different format. This is one of our Q&A topic weeks. And so with that, we're going to be fielding any questions from you that you may have top of mind, and then we'll fill in with some education pieces on our end. So with that being said, since it is a different format, Pete, I'm actually going to hand it off to you if you'll give us an idea of what today looks like, and then we'll go from there.
Thanks, Megan. So today's going to be a little less formal in the structure, and normally we'll just, the last Thursday of every month going forward, I'll look through the Discord channel in the tax section. And if there's any questions there, I'll pull those questions out and we'll kind of do a high level recap of the questions on this show. Usually those questions will be for that month's material, but there'll also be some random questions that we can bring up and discuss. Unfortunately, when I checked the Discord earlier today, there wasn't a lot of questions. So this show may be a little different where we kind of just take some random questions live and try to answer them as best we can based on the knowledge and the details we have. So.
All right. Well, sounds good. Well, Pete, do you want to go ahead and hop into that Q&A portion now, or is there any introductory information we need to give or anything?
I think we can hop into it now. Just remember, it's March 29th and the tax deadline's approaching in April. So if you haven't got your taxes done, file an extension.
There you go. All right, guys. So if you have questions that are top of mind for you, feel free to either drop them in the chat. We'll be reading and checking for those. Or if you want to use the reaction button, throw your hand up. We'll walk through them that way as well. So we'll open it up at this time. Any questions you have?
I'll ask questions. I don't know if they're smart questions, but let's see. So I set up a self-directed IRA about a year and a half ago. And actually, I just signed up to work with Pete to do my taxes this year. So this may be like a real-time consulting. So I retired last year. Can I start making deposits into that self-directed IRA and avoiding reducing my tax exposure?
You retired mid-year, correct?
Yeah. And maybe how is a self-directed IRA different from a solo IRA? So I've seen that term used too.
So your self-directed IRA, you can contribute your $7,000 into that. I believe that's your contribution limit.
Okay.
So you can still contribute in 2022 before you file your taxes for the 2021.
Even though there were, even though I had a 401k in my job that I had for half a year, I could still contribute?
Yes.
Chris is nodding yes.
Yeah, I believe you can. And then a solo IRA, do you mean like a solo 401k or are you?
I guess that's what I've seen, this reference to solo, and mine's a self-directed, right? I had an IRA or whatever at the companies that I worked at here in Silicon Valley. And then I turned 59 and a half and I rolled it all over into one account. And then now I have, I formed an LLC and now I have a self-directed IRA that.
I can say something only because I'm selfish. This is like my favorite topic.
Is it?
Yeah. and I'm actually glad my microphone's working now. So this is a good thing. It's the limit is 6,000 unless you're 50 and over, then it's 7 for 21. The solo is like Pete is saying, is the same, except you can, invest in alternative assets, like real estate, for instance, which a lot of us are involved in. If you can, now, are you totally retired or do you have you said you have an LLC. Is that just to hold your real estate? I mean, is everything 100% passive, or do you have anything active?
I'm actually tutoring computer science at the local community college, but it's like $500 a month. It's nothing.
That's all you need. I mean, you could have a hobby that makes you $50 the whole year, and you can start, a business. And the reason I'm asking you this is because, and again, like everything, I got to preface it that I'm not an attorney and I'm not an accountant. But my opinion and the opinion of a lot of people is the self-directed 401k has so many benefits above a self-directed IRA. And if you can go that route, it's reduced fee, it's reduced exposure to problems and such like that. And the ongoing costs can be a lot less expensive and a lot less onerous. You don't have to go through a custodian, every time you want to do a deal. So I'm a very big advocate of a 401k over an IRA. Now, that's not an option for everybody, but if it is for you, I would highly recommend it.
So, I mean, to your point, right? So mine is actually, I have a custodian, and my only interaction with them, because the money is actually in a business checking account at my local Wells Fargo. And so all I have to do is like send them an annual, I don't know, I have it here someplace.
Now, is it an IRA? Did they set up an LLC for you with that IRA?
I set up an LLC, and I think it's a self-directed IRA, and I have complete discretion over it. They all they ask for is an annual. They charge me like a couple $100 to refile and reestablish LLC or whatever every year, and then I just have to tell them how much is in it.
Well, if you already have it set up and you're already retired and you don't want to deal with any corporate complexity, well, actually not in corporate, you can just do a solo or a solo prop as well to back up the 401k. Is it Roth or traditional?
It's traditional.
Okay. I mean, there's so many questions I could ask you. I mean, just broadly speaking, I'm a huge advocate of Roth. Only because who knows in the future what the tax situation is going to be. And, when anybody tells you, or if you're having a frank conversation with a friend and they tell you they have this much in retirement, and it's all traditional, unlike assets out of retirement account, if it's traditional and it's any size, half of it's going to government, because it's all ordinary income when you pull it out. Right. But if you want more control over it, I just love having, the growth of a Roth and having it tax-free while it's in there and tax-free when I want to pull it out. And I took a huge tax bite about 10 years ago, moved over my self-directed 401k from my W-2 job that I had back then, paid over 6 figures in taxes and converted the whole thing to Roth. And I put all my cherry deals into it over the last 10 years. And because of that, my effective tax rate is so incredibly low. And living in California, I could use every tax rate out I can get. But the nice thing about, I mean, it looks like you have a decent setup, and if you're doing relatively conservative investments, fine. But if anything isn't even remotely gray, where you got to be careful is that if you do a prohibited transaction in an IRA, one transaction blows up the whole IRA. So if you've got $1 million IRA and you make a $30 mistake, I mean, feasibly, the IRS could basically make you distribute the whole IRA. Whereas a 401k is transactional. If you do a prohibited transaction on a specific deal, it's only to that specific deal. The nice thing about now in your situation, if you do convert it over to Roth and you keep it with the IRA, then, when you turn, well, actually, I don't know what your birthday, what that would be, but it's, obviously when you turn 70 or 72 or whatever that number is now, you start having to make distributions. But if it's Roth IRA, you don't. So that is a benefit of keeping it in the IRA. Now, for myself, I'm probably going to keep it in the 401k. And even if I make distributions, I'm either going to be okay with that, or there's a really nice little idea that maybe one of my daughters will take over the business, and I will just stay a small percentage owner as an employee of them. And as long as you're still employed, you don't have to make distributions on your 401k. So, there are lots of options out there. I have to preface too that I put a lot of time and research into this, But I've always got to tell people is be careful with the complexity, worry more about getting the good deals. And if you're spending more time on the complexity of where the money's coming from, your focus is not in the right place. I mean, it's always a good idea to be as tax efficient as possible, but focus on the good deals first.
I guess maybe does anyone know what is the difference between self-directed IRA versus self-directed 401k?
Well, there's a number of differences. One is what I just told you about transactional versus blowing up the whole retirement account. One of them is, like I just said, about the distributions in your 70s, that even with a Roth 401k, you have to make distributions. With a Roth IRA, you don't. So everything except for a Roth IRA, you have to make distributions. Is it easy? Whether it's solo or regular or traditional Roth, after tax, whatever. Another benefit of a Roth IRA too is, and unfortunately you can't do this in the same way with a Roth 401k, is if you want to make distributions before you're 59 and a half, with a Roth IRA, any of your initial contributions, I shouldn't say initial, any contributions you made, that amount, you can withdraw at any time. It's already been taxed. And there won't be any tax repercussions for that. And there's no early distribution, 10% early distribution fees. So that can be a really big plus to some people, especially if somebody's retiring early and they want some access to those funds. I would argue, really try hard not to access those funds, because they're just accumulating, more tax-free. And once you pull it out, you lost it. Okay. So that's a big deal too, to some people. If you try that in a Roth or 401k, it's got to be a percentage. So if you made 60% on your money, and so the original 40% of it, you got $100,000, and 40,000 is a contribution, and 60,000 is gain, then any money that you pull out early is going to have a 10% withdrawal penalty. And the only part that is tax-free is that 40% of whatever you pull out. And you don't have to worry about that with an IRA. I just love that I don't have to deal with, I have very time sensitive. Some of my cherry deals are very time sensitive. You got to send a wire and you got to send it now. And I guess with the LLC, maybe you don't have that problem. I don't like more entities. I live in California and everything requires another entity fee. Minimum of 800. Everybody says 800, but it's minimum of 800. I could show them checks for thousands of dollars I've sent on some of my entities, just for the right to have it foreign qualified in California where I live. I find there's a lot of benefits and then also in terms of cost, there's ongoing costs associated with having a custodian that's not yourself. There are some companies you do a one-time fee to set up your 401k, and I only recommend this for people that are very disciplined, but there's no additional cost, especially if you're able to if you're over 250,000, you got to send in a 5,500 easy. And people are like, oh God, it's a one pager. It literally says, what was your amount what was your 401k worth at the beginning of the year? And what was it worth at the end of the year? It's very, very easy to fill out yourself. So if you've already, it sounds like you've already got something set up. I don't know how much is in it and what you plan on doing with it, but it may be better off in your situation not to. But you're also, since you're retired, probably in a lower bracket than you may be either in the past or in the future. And if you're at a lower tax bracket, there's some fun play you can do there, especially if you know a particular year is going to be a lot less than others. You can transfer some of that money over to Roth during that time period as well.
Yeah, I think the only thing I'm worried about now is that I invested in a bunch of real estate syndication deals, and I think I have some UBTI exposure.
Yes.
Okay, that's another issue. Well, and that's another benefit of 401ks. If you're borrowing, well, I don't know so much in a syndication, but if you have rental property and you borrow money, you will be paying UBIT with an IRA, and you don't with a 401k. Specifically for borrowing money. I got to make that clear because a lot of people think that there's no UBIT with a 401k. Trust me, there is, just not in that particular case. But if you're running a business out of your 401k, if you're flipping multiple properties out of your 401k, go ahead. If you do more than 3 a year, you're likely getting in a scenario where you're getting UBIT. You could argue if you do 2 to 3, maybe you're not. I would recommend if you're doing that, I would recommend doing a little bit of UBIT and declaring at least a little bit on it, just so that you can get the statute of limitations started.
Hey, Chris, what is UBIT? I'm sorry, I'm not familiar with that term, UBIT.
Unrelated business income, taxable income.
It's
So,
based. Go ahead.
If you buy a property and you put 50,000 in cash and then you have 100,000 in finance debt, theoretically,
Okay.
2/3 of it would be subject to the UBIT tax because you're financing 2/3. But with a solo 401k, up to 50,000 of that, you wouldn't most likely have the UBIT on that portion.
Right. And look, it's there for a reason. I mean, if I'm flipping properties and I do it on my 401k and you're flipping properties, you're doing outside, and we live in California and we're both in the 40% tax bracket or higher, I have a huge advantage over you. And this goes more for business. I mean, if we had like a business habit or things like that. So there's a reason they do that, is to protect other people that don't have those kind of accounts. But there are ways to avoid it legally. The 401k allows you to do that if you're borrowing money. Now, I am not, and this is not a popular thought, but I am not an advocate of owning real estate in your 401k or IRA in your retirement account. To me, it's akin to having tax-free bonds in a retirement account. You're getting none of the benefits and write-offs of having it outside. So I prefer to lend money out of my 401k or do short-term things that would otherwise be ordinary income. Now, look, if it's the only pot of cash you have and you've got a good deal on a rental property, do it. It makes sense. Or if you know your basis is going to be extremely low, you've got some inside information or whatever on a really up-and-coming area. I wish properties I bought for $6,000 that are worth $300,000 now that I bought 10 years ago, I had them in a Roth, because that would have been awesome. But I don't, and that's okay, because I still get huge write-offs for rental property. I want to make one point really clear too, and then I'm going to let other people speak. The one other caveat with Roth is be careful where you invest it, because we tend to invest in our cherry deals and maybe some of our more risky deals. If you lose money on a deal, there is no writing it off. You've lost it. It's poof. And that can be very, that could hurt. Whereas, at least if it's traditional, then, you already got the tax write-off and some benefit of it. If it's outside of a retirement account, well, then you can write that loss off against other gain. With the Roth, poof. I want to mention, and I'm going back on my word here, but only because you mentioned syndication. I learned something the other day that I wish I had known earlier, and it's a bit more complex. But if you're in a position where you're transitioning from traditional to Roth, there are some tricks out there that can reduce your tax exposure. And one of them is like this. You invest in a syndication or in something where you have very limited control. And you invest it with traditional dollars. And then after it's titled that way, you ask them at that time, at the time that you've now lost all of your control or a big part of it, to now switch it over to the Roth. And when you go to pay for it, and I wouldn't do this with your own, I would get professional people to appraise it for you. But because it's considered of lower value now, because of the lack of control, how many years it will be before you have access to it, and this is coming from the estate planning world, you now have a lower basis for it, and therefore will pay lower taxes. So if it was worth $100,000 before and now it's worth 65, you only have to pay taxes on a percentage of what you've now transitioned over. Something new I learned. I wish I knew this years ago. but something you may want to consider if you're ever considering, trading over to Roth.
Because in that example, Chris, you're saying when you transfer your property out of the IRA, you're actually only transferring $65,000, and that's what you're going to have to pay the tax on instead of the 100.
Exactly. Now, it's all about semantics. You're not transferring out of the IRA, you're just transferring it from the traditional IRA over to Roth IRA. And it has to be after the fact. You can't, pay for the transition and then invest in it and say, oh, it's now worth 65. It's got to be, you invested in it at the time you had 100 grand. You invested in a vehicle that now you get a professional appraiser, or there are people that specialize in doing this. That will tell you how much your investment is actually worth now. And it could be also because now they've torn the building down to the studs, or, it's not as sellable and you don't have control, and the operating agreement says you don't have access to it for, now you gotta make sure these are people that you trust, or that this all makes sense, but you could really reduce your tax burden legally by doing this.
Is there a name for it?
Hey, Pete, you're now muted.
72 is the start of the required minimum distribution. So the IRS did change that recently to where you have to take less out to start with. So you don't have to take as much in your beginning years as you used to. But that's kind of viewed as that way you pay more on the estate tax when you pass. So the best way is probably not to try to have any RMDs if possible.
Hey, Jeff, I've been using the Solo 401k for a few years now, and I really like it. I just found this out a few months ago when I transferred an old traditional 401k from a previous company into it. It gives it some nice flexibility. So I kind of shove all my cash into the traditional, take the write-off, on my W-2 income from my business. And then that money sitting in the traditional, I can peel off as much as I want because I'm the fiduciary of the Solo 401k. So it's not like a traditional company where you either have to quit in order to get access to it. I can take, if I look at my tax situation at the end of the year and feel like, okay, I got some room in this tax bracket where I can roll it to a Roth, I can do some planning on that in trying to convert as much as I can. And then also, if it, like in Chris' example, if it's $1 million and you don't want to risk all that money in the case you do a improper investment in there, you can carve off, take 100 grand, put it into a self-directed IRA, so that it's at a different company, or a different account, so that you're just dealing with that and leave the rest in your Solo 401k.
Well, let's get a little clarification about that. I don't know that you'd necessarily, it depends what kind of risk we're trying to mitigate here. If it's against prohibited transactions, you actually don't need to do that because it's with a 401k, it's transactional.
Okay.
So the whole 401k. If you're doing it, for asset protection and things like that and having in different vehicles, unless you have some other entity like an LLC, it's not improving your situation. Okay. One of the deficits of a Solo K and an IRA is there's no what's called ERISA protection, which is this government protection that really prohibits just about any creditor from getting access to your retirement funds. Now, depending on what state you live in, some states give non-ERISA protected retirement accounts just as much protection as ERISA. I will tell you, here in California, and this really freaked me out when I found this out not too long ago, is that a judge can determine how much he or she thinks you need for retirement, and the rest can go to a creditor. So be careful. I'm considering creating a safe harbor plan or some other plan and hiring somebody, or I'm looking at what my options are. But I really want that ERISA, or I really want at least some form of asset protection that will make sense. But be careful and know that.
Hey, Chris, have you looked at insurance for your asset protection, like IULs?
Oh, I've got a ton of umbrella insurance, and you're hitting it spot on. It's a really good question, and it is important to do that too. But I live in California, and my daughters are teenagers and learning to drive, and there's always a breadwinner somewhere, and it could potentially go above. I mean, it's exceedingly unlikely, but it could go above my umbrella. I mean, I've got a $5 million umbrella. I could hit a breadwinner that is making $1 million a year, and they could sue me for 10 million. And now it's going against my personal assets. So things happen. But yeah, you're right. Having umbrella insurance is key. There's also, and look, I'm not a paranoid guy, but insurance companies try, and they should, as any business should, try to weasel out of making payments if they have to. So that's why I believe in multiple layers of asset protection, and certainly insurance is at the top of the list of what you should cover. Pete, do you recommend to your clients like any particular amount of umbrella? Do you say like, if somebody's worth 10 million, that they should have at least a 10 million umbrella, or is it just how risk adverse they are, or how do you have any recommendations for that? You're on mute.
Dollar amount to do a ratio that I've recommended. I just know I personally try to cover at least a third.
A third of your net worth. Okay.
Is what I do personally. Grant, depends on your net worth. If your net worth is huge, you're going to want to buy more. If it's starting out, you might want to do 100%. It really, I think, depends on your total dollar net worth. If your net worth is a couple million, you can buy 2 million worth of umbrella insurance for pretty cheap and have 100% protection. So,
right, and I'd also argue it depends on what state you live in. I mean, if you have the majority of your wealth in a retirement account and you live in a state with ironclad retirement savings asset protection, then maybe you don't need as much.
Yeah.
But being in California, I love the weather here. I love my friends and family. I love so many things about it, but it is not landlord friendly. It is not business friendly. And it's a very highly litigious state too. So we all got to figure out our own personal situation.
I've also heard on the with the higher umbrella policies, I don't know how true this is, you get the better lawyers with the higher coverage you get. Trying to defend, $10 million policy versus $1 million.
Well, to your point, what some people do and what I do is, you have your general policy and then you have your umbrella. And most people, they just bundle it and they get it from the same company. It's not too much more expensive, and sometimes it's even less expensive if you go out there and you look and see what's available. But if you have 2 levels of insurance, you'll have 2 sets of lawyers.
Yeah, yeah, that's a good point too.
That's an interesting point. The double coverage there with 2 different companies, right. Or you got to fight with 2 different companies to have them actually pay.
I guess. But no, I mean, one is liable up to that limit, and if it goes above that, then you're fighting with the other company. But I'd like to. Sorry.
I meant of them actually paying. So
I know. Yeah. Well, yeah. I mean, yeah. But I would. That's a good point. But I like the idea of having the double 2 sets of lawyers. Why not? If you have to. God forbid we never have to use it. But it's good peace of mind. And you got to do what helps you to sleep at night too.
Well, that's a good point. You said you have teenage daughters driving, so you may want to be more risk averse and have a bigger umbrella. While if you're empty nesters, you might not need that. So, yeah.
Although a lot of people who don't think they need it, need it. I mean, I mean, it's a bit personal, but I mean, well, then again, I think anybody who's been working for a while eventually is going to get sued. I hate to say that. There's so many frivolous lawsuits, and I had a frivolous lawsuit, and I was nothing more than foreclosing as a lender on somebody who stopped paying. But it doesn't stop them from getting a lawyer. And I mean, this is not like England where you've got to pay up ahead of time. Great. they declare bankruptcy. I can't, get anything. But even just being a lender or buying notes, well, I guess buying notes, that's something different. But just lending money on somebody with excellent credit, you would think, how can I get sued being a lender? How? It's not my house, whatever, but you can. And people will. And just because you're right doesn't mean that you're not going to have to defend yourself.
Yeah, that's true.
Julie, I think you asked me a question, what something is called.
Yeah.
You said you put something IRA, and then when you don't have control, the value goes down, and then you can roll over to Roth at a lower base. Is there a particular name for that, so you don't have to explain in 5 minutes? So if there are
names, you have to explain it to somebody.
Yeah,
you're not talking to the right people. Because it's so rare that this happens that I would want to have experts that do it for me, because I'm not going to try to explain it. So whether, who's ever doing whoever, and I have access to people who do this, and it's not like I know people who have done this, and I'm sure I could get, who they use as the people who did the appraisals and such like that. But I haven't done it myself yet. I just learned about this about a month ago. And the only thing I had was regret that I hadn't used it myself. You got to be okay with it, because you literally have to have limited control. Now, you could argue if you have a financial friend and the operating agreement says it, but you have such trust in that person that you're okay with that limited control. But you will have limited control. And it does have to be an asset that likely has to be tied up for a while. And there isn't any set percentage. This is why you need that outside third party to, officially do this for you. But I've seen some substantial like over 80% reduction. And it can make a lot of sense for some people. And if you, a lot of entrepreneurs, you have feast and famine. You have some years you make a ton, and you have some years you're at a loss. And if you can work that arbitrage to where you're converting certain assets, during those time periods, for capital gains, for converting to Roth, I don't see enough people doing that. And it can really, really, really help out in reducing your taxes if you can work it that way.
Yeah, good point. Thanks.
Sure. Does anybody have, and I think I've asked this before, and maybe I'm repeating myself, but I'm still on the hunt for a good personal software for accounting and just basic bookkeeping. I use so many different ones for business. They don't work terrific for personal. I've far outlived Mint. I like Mint, and I still use it because if I ever want to know, specifically of a certain transaction, I can just go in there and type in the search box and I can find it. But it's just not good for people with alternative investments. It's just not great at all. But does anybody use Quicken or anything that they recommend? Or
I think QuickBook is the best.
But that's more for business, or do you use that for personal too?
Well, for personal, if you just want to get a free one, there's one called Wave. That's pretty good. And it's free. Wave. WAVE. It's free, and I used it, and it's pretty good. The best thing is, if you have different bank accounts, try to separate them for different purposes so that it makes bookkeeping so easy, because you don't have to categorize them into different things. So for me, let's say I have one bank account for A business, another bank account for B business, another account for personal, and then you can have 3 different Wave accounts, different user ID, just link to different bank accounts, and then they're just separated. So you don't have to constantly do bookkeeping, because when you spend the money, you already know what category they should go to.
Have you ever used Mint?
I haven't.
Okay. I'm just trying to see what the differences are between the two.
Okay.
What does Mint cost then compared to Wave? Is it like 20, 30?
It's free.
It's free.
But it's like really
Advertising.
I use Mint. I use Mint just because it's an easy tool for my wife and I to kind of keep track of with kids, all the expenses flying in if we have money for something or not. But I only limit it to, I don't put all my business stuff in there. I just have my one kind of household operating account and a savings account, and then that's it. And I don't really, it's good for kind of keeping those transactions going, but it's not good for like doing your real estate.
It's not, and its biggest flaw I find, well, there's two things. One, it's so advertising intensive. I guess they have to make money somehow. But for me, the biggest flaw is there's no bulk input. If you want to add something that's not automatically in from a bank account or some other account, you got to input it manually, which I'm fine with, except you can only do it by individual transaction. And like for me, I spent years, I have backlogs of Mint data in there. And, I didn't log on for like 3 months at a time one time. And there are some accounts that have hundreds of transactions that I'd have to go in and individually input it because Mint won't go back far enough with certain accounts. So be very careful if you're using it for that. It's one of the reasons I want to move away from it because I can't do any bulk entering of transactions. Julie, do you know if Wave allows you to do that?
I think you can import transactions. And also, and another thing with QuickBook is that a lot of people, they want to have the professional QuickBook. That's going to cost you maybe $80 a month. And then they separate like each property. But for me, I think the best one is QuickBooks Self-Employed. That's only $15 a month. And if you have 2 accounts, that's only $30 compared to the professional QuickBook. And to me, because it tracks receipts and it matches receipts perfectly with the transaction that you downloaded from the bank. So, and then you can sort it at any way you want. So I think that's very user-friendly. It costs you a little bit, but that's the best software I used so far.
And is QuickBooks, Julie, like really good for, individual properties like where you can set up your custom categories?
The thing is, if you want to have, let's say you have a few and you want to categorize each transaction to be under each, you have to get the professional QuickBook. That's more expensive, right? So if you only have 4 properties, instead of spending $80, you could just spend $15 for each account. And then that's only $60. So what I'm saying is you unless you have a big portfolio, you have like 20 to 100, then you should use the other one. What is called?
Buildium is a good one.
Yeah, if you have a huge portfolio, you could use that one. But if for me, I have a small portfolio, I just use Stessa. I think that's good enough.
I started using that too for. I use Buildium for my Columbus properties where I've got a bunch of properties, but I've just started in Tampa and my partners are intent on using QuickBooks right now. $80 a month. It's such a pain. And I'm playing around with Stessa. There are 2 things I really love about Stessa. The biggest thing is that it's free and I like free. And then 2, it's the only one I know that if you have a professional manager who's managing it and they have either AppFolio or Propertyware, it's the only piece of software. And if anybody has any others that do this, please let me know because Stessa has other shortcomings. It will automatically import their reports just like a bank account into your account. Yeah. It's huge. I love it. So what I'm planning on doing is importing it into Stessa and then exporting from Stessa into whatever program I'm eventually going to use. I personally like Xero over QuickBooks because it's the same format and considerably less expensive. My accountant, it's for like a professional account, it's $10 per entity. If I can get away with not doing the bank automatic transactions, it's $1 a month. And I find it's much easier to use than QuickBooks. So I know this sounds weird, but I've got a whole bunch of different entities with different partners. And so I've got Xero, I've got QuickBooks, I've got Buildium, I've got Stessa. And believe it or not, it all works because at least it's online and all my stuff is out of state for the most part, so I can get to it. But I do have recommendations for that, but I haven't lined up yet personally is my personal stuff. That's not as good as I want it to be. And I will probably go to something like Quicken. I'm vacillating and still researching, but yeah, I'll check out this Wave one. Maybe it has what I'm missing. Definitely. But does it have? I'm assuming you can import from bank accounts, and they don't charge you for that. Great, and they don't send it to Russian hackers either. The encryption's halfway decent.
Probably will report to IRS. Be careful.
I don't care. I mean, IRS. I mean, look, if there's people listening in on my Echo devices, if the IRS wants to snoop, and the people are gonna be very bored that listen to me, and the IRS is not gonna get anything because I'm very organized with my numbers. Like, I'm not inviting an audit. I don't want it, but I don't lose sleep over at night on that. But I would doubt that they would. I mean, isn't it? I mean, not them, but the banks. Isn't it anything over $600 now, or did that not pass? That they have to submit.
It did not pass.
It did not
Not yet, right?
To my knowledge, it had not passed.
Good. So what is it? Just transactions over 10 grand? I think that they have to.
Yeah, the CTRC is 10 grand for banks. If you're like in casinos and gamble, they'll do like a money transaction log at about 2 to 3 grand. So it just kind of depends on the business. So
got it.
I wouldn't be shocked if the companies are reporting over 6 or already have it logged, but
they probably have it logged. It's just a matter of if it's subpoenaed. But
yeah,
if you're an American citizen, I would say it's going to be a very hard pull for a private company to release information unless they're, I don't know, they think you're some espionage, but or you're a crook. Yeah. Pete, do you have any recommendations for personal software?
So I use QuickBooks. That's what I've used for RS, doing the books. Some of the clients that we do bookkeeping for, we'll do QuickBooks, and then we'll set the properties up as customers. And then when we run the report, we'll just run it by customer to get the specific property detail.
Do you like customer rather than class, or?
You can do class or customer. You just want that. You just want that filter to be able to break the properties up so you can see them in separate reports and break them out. Or you can just run the overall report to see how the portfolio is doing overall. But we also have clients that use Stessa a lot because it's free and they're able to export the reports in Excel to me. So
yeah, those are good. Those are good recommendations. But yeah. I'm talking less about the business side and more about the personal side.
The personal side, being an accountant, I do everything in Excel.
So you do everything in Excel, don't you?
Yeah. That's really what I'm good at, is writing code and formulas in Excel and creating graphs and charts and all that stuff. And then
it is a lot of fun.
I just download from the bank, put it there, pivot table, VLOOKUP, boom, I'm ready to go. So but I don't have a lot of transactions. So.
Yeah. I love doing that too. And you can do anything on YouTube these days. If I need a formula and I need to do something, I can look it up and find out how to do it.
Yeah, but people have used Quicken before that I know for their personal. Sadly, a lot of people don't have anything and don't really pay attention.
Most people don't.
Yeah.
Most people don't. I liked having a full picture and seeing control over it. And if you're trying to reduce expenses and you don't even know what you're spending your money on, I'll be frank with you. I'm helping my elderly mother out now. And she spends a lot of money on superfluous stuff. And, when you don't know that you're spending $1,000 on numerology, by calling and talking to somebody, when you see it and you print that out for that person, it can be an awakening when they realize how much of their money is going towards something that at the very least, they need to be aware.
Yeah.
You know, we all have these subscriptions nowadays. We have so many of them. Half the time, if you're not checking on a regular basis, you might be paying for stuff you haven't used in years.
Correct. Or when you sign up now, I've noticed they offer you the free trial, and it used to be where, oh, you have a monthly charge going forward, but now they've changed it to a yearly charge. So,
Exactly. Or something.
Be careful when you sign up for those apps. But yeah, in Excel, what I'll do is I'll build out like a cash flow statement for 12 months. This is Pete's budget. This is what I spent this month. And I have tier ones like utilities, home, mortgage payment, blah, blah, blah. Tier twos, you know, bills I need to pay, but I don't really need to pay. And then tier three is I'm just going to go have fun this weekend.
Is that something, and I'm putting you on the spot here, that you feel comfortable sending out a template for?
We could do a very high level, basic one. Just depends on kind of what people. I can do a big budget dashboard one, a high level, just kind of show you a format.
I would love that. I mean, because I feel comfortable with Excel, and I wouldn't mind doing that. Now, do you manually import like all of your data from the different bank accounts and stuff, or do you have a way that it does it automatically through?
No, it's you got to download a report like a an Excel file, or I think is it a CVS file?
CVS. CVS is the pharmacy, I think.
Yeah. So I'll download that file into just tab, because I use one credit card, so I just monitor that credit card. So
there's an add-on. I'm assuming you're using Excel, like 365. Yeah. I think it's Microsoft Money has an attachment for Excel that's free. If you've got that will actually download automatically for you.
Okay. Yeah, I'll check that out. No, I normally just run the monthly report, download it, because I see the transactions line by line item, and that's where I catch.
Good idea too. That way you're forced to look at each item.
Yeah, where, hey, what is this? And then I can dig into more detail, because a lot of businesses, at least where I live in Boise, doing business and what their charges is very different. So, but I'll just do it.
I just wanted to say that I paid for a strategy session with Pete, and it was great. If anybody wants to do that, he sets up a lot of he'll do an Excel sheet for people and set out all your properties and which ones are, maybe people do this already, but which ones are capping the best. And it was really helpful. But I did need a follow-up a little bit with you, Pete. And so I don't know, I paid the fee and for a follow-up, and I hope we can get together just to go over some. I just have a few more little questions, but they're, just easy. But
yeah, I've got your questions written, Kim. There's a lot that I needed to get answers to. I just wanted to get them all answered before I give you a call. So
okay.
You'll hear from me probably tomorrow. I'm just a little bit busy with some tech stuff.
Okay, perfect. Because it was so helpful. I mean, if anybody wants to do that with Pete, it's tax season right now, so it's probably super busy, but anyway, it was great. And I really appreciate it. So thank you.
Yeah, you're welcome.
Pete, I'll take up the time, guys. I mean, if anybody else has questions, I'll shut my mouth, but, I have a question that, I guess it's relevant to the group too, of a write-off that I heard of recently and want to kind of get your feeling or blessing or what you think. But I'll tell you what I'm doing now, which I know is fine. And then I'll tell you the caveat of that, which I heard about and I'm hoping is true. So I've been paying my kids a salary for over 10 years. And the older they are, it's age appropriate, and I pay them up to the standard. I mean, they're both older teenagers and they do stuff for me. And I pay them up to the standard deduction. But my oldest has turned 18, and it's my understanding, and I'm 99% sure on this, that if they're under 18, you don't have to pay payroll tax, assuming you're not paying out of a corporation. The entity has to be a sole prop or an LLC, not taxed as an S corp or C corp. But that's not my question. So my question goes like this: is I was just going to stop paying after they turn 18, but I had an accountant tell me that you could pay your daughter, your older daughter, assuming they could do like a really big project for you, they could do a one-time big project for you. And as long as it's only like a one-time, there's no payroll tax for them. So, I mean, if they did a big enough project that it was a 12 grand project and, I paper it, make it legit, that they don't necessarily have to pay payroll tax on it because it's an ongoing business. Do you have any feelings behind that?
I have not heard that. I've heard of the deduction of paying your children to lower your taxable income. Usually I'd view that though, and I'd have to do more research on that one only time entity, but normally if you'd pay her the $12,000 or stay below the minimum, she's gonna have to file that kind of as a Schedule C because you're giving her a 1099 NEC. But since she's 18 or over, she might get the earned income credit. And it might zero it out entirely, even if she had to pay the payroll tax. So
okay, yeah,
that could be another aspect. But I'd have to look on the one-time engagement, whether it'd fall under employee earned income or if it's more of like a royalty or.
I will look it up because he gave specifically where to file it on and everything. And if I find it in my notes, I'll bring it up.
Yeah, you could, because.
But that intrigued me. I mean, he even said like up to 22 grand. I mean, or he used even the number 22 grand. I haven't followed up with him, but I will. But more so, I want to know how often I can do that. Twice a year, once a year, every other year. I mean, what would be, and I wouldn't use the same amounts and I wouldn't do the same projects, but I like this idea of, well, at the very least, hang her out to 6 grand so that she can, put into a Roth IRA. I've been doing that forever with my kids. They have great size IRAs because since they were young, I paid them out to at least to that and went straight into their Roth. I got the write-off and they get the Roth tax-free for life and don't have to pay any taxes on it. Yeah,
no, the 22,000. I'm wondering if he's doing an earned income credit. So, but.
Box 3, Form 1099, miscellaneous. So we're good. And then Kids Form 1040, one-time income is reported as Schedule 1? No, that's Schedule line 82, other income line.
Yeah, it's Schedule 1 where it lists of other, like where teachers can do their deductions for 350. So what that does is you put at Schedule 3. He has it in box 3, so he's not having it as like a contractor pay income. So instead of having it flow to Schedule C, he's having it throw to like the Schedule 1 as income, which then does avoid the payroll tax.
Then I guess the reasoning behind it is it's a one-time project, so it's an ongoing business.
Yeah.
I guess my question to you, if you think that now, I don't know, and I'm okay with levels of gray, but how gray is it? I mean, if it's a one-time project, I'd be surprised if you get it on it, But do you think this is something you could get away with doing like one project or 2 projects a year? Or does that now start looking like a trade or business?
I think it would just depend on the amount that the total, all the projects add up to. I think that's more the bigger concern. And if your risk tolerance is high, I mean, you as a business, it's an expense, you're fine. Your daughter may have to pay a little tax. You've got the payroll tax.
Still a lower tax bracket than me, so yeah.
Correct. So, I mean, you can run it and try it. If you get audited, if she gets audited and has to pay, it's still going to be lower than what you had to pay. And it's not going to be that much because you do, even if she had to pay the payroll tax, you do get a credit for half of it. And then I would argue, depending on how her taxes are filed, she could even fall under earned income credit and that all gets zeroed out. You may even get money back.
Interesting. Even if she's a dependent?
That would be the change in dependent. So that's where you may not claim her as a dependent to get your $500 tax credit if you get it. And she's just an independent at that point. And then she might be able to get more money back through an EIC.
Okay.
But it'd be a scenario you'd have to run.
She's going to be turning 19 soon and she lives in the house. I mean, as long as she lives in the house, even if I don't declare her as a dependent, could it be argued she is, or does it? It's just a matter of what I'm willing to claim or not.
Is she going to school or?
She goes to school, but locally, and she lives at home.
Yeah.
And
So
for a while,
you could not claim her as a dependent. I mean, just because she lives at home doesn't mean she's a dependent. I mean, the IRS asks those questions to be a dependent, but you could not claim her. I mean, you don't have to claim her at age 19. So.
Okay.
Yeah.
I like this.
I'd have to honestly research more on the one-time thing is not a continuing business and income. That I would just be conservative and say it's Schedule C, but you could file it under that other form, tax form, and then you would also just risk an audit, but it wouldn't be that much if you did get audited. So depends on your risk tolerance.
Write-offs. I like it.
So it'd be cheaper for her to pay taxes than you. So.
Hey guys, we are coming up here on time. I do want to flag, I've got to hop out right at 2 Central Standard, but we typically keep the room open with a couple of staff members for a few minutes longer if you guys have other questions. But thank you to Pete and thank you for everybody bringing your questions today.
Yep.
So, as Pete mentioned at the top of these calls, we're actually going to try to source as much as we can inside of Discord for these Q&A calls, just so we can have a better prep period for them. So anything comes up over the next couple of weeks for you that you want answered on our next session like this, just drop it in Discord. Our team will keep a running log of it and make sure we've got it going. But thank you so much, guys, for joining. Like I said, it'll probably be open for another minute. I'm going to go ahead and hop off, but I hope to see you guys in one of our other calls this week. Bye, guys.
Hey, guys.